Well, thank you very much. Comer Hall has changed a little bit since I've been here on the inside. Anyway, let me ask a couple of questions, and so I'm going to sort of gear what I say according to y'all's answers. I recognize a few vices from the Ag Prices class this morning. How many are seniors and graduating? Okay, a few. How many are planning on not going back to a family farm, but going out to some other career, looking for a job later? So, more in that camp. Well, let me tell you a little bit. First of all, let me tell you a little bit about Protective, and then I'll tell you how I got there. Protective is one of the largest sellers of life insurance and annuities in the country. We're based in Birmingham, Alabama. We're about a $70 billion asset company. I'm the chief investment officer. So the way insurance and annuities work, you make deposits, you accumulate a lot of cash, people pay premiums over many, many years, and you hope they live a long time, and you build up these reserves to meet those benefits. Or if it's a retirement product, you take a bucket of money and invest it, and then you pay out your annuities or retirement funds to people over time. So if you look at my portfolio, we're about $40 billion of fixed income, which is bonds. We have about a $6 billion portfolio of real estate. We have about $12 billion of separate accounts that are invested in stocks and mutual funds and various investments of that type. And then we've got a big derivatives book where we hedge our liabilities. So we sort of cover the whole gambit of investment products. But, and I'll get into a little bit about why agriculture is important to me later. But how did I get to Protective? Well, I graduated from here in 1978. Well, the 60s and 70s were not kind periods to agriculture. I mean, that was sort of a period of bad prices. It was not a real good time to be in agriculture. I grew up on a family cattle ranch outside of Demopolis in Galion, Alabama. And it was a large enough ranch to support my parents, but it wasn't large enough for me to go back and have a family and, and go back to the family farm. When my parents sent me off, they said, well, you don't really need to come back because we're barely getting by, so we ain't got enough room for you to come back. So I came to Auburn and enrolled in architecture. So, like a lot of people, I joined a fraternity and had my social life. And after about a year of driving by the architecture building, which was on the corner of College and Magnolia on Fridays and Saturday nights, and seeing the lights on and people in there working, I decided I wasn't going to be an architecture. So, and so what did I really like? I really loved agriculture, and so I switched over to the School of Agriculture. Well, in 1976, Jimmy Carter was elected president, and Jimmy Carter was a peanut farmer from Plains, Georgia, and we had a Democratic Congress, Democratic president, and at the time, the Democratic administrations were very friendly to the agricultural community. The agriculture community had been very depressed, and so they, under Jimmy Carter's presidency, they started doing a lot of funding through the Farmers Home Administration and various other federal programs to encourage farming. So they had a program for beginning farmers. And so being not so risk averse, we talked about risk earlier in the Ag Prices class, I decided, well, I'm going to just go borrow a bunch of money from the Farmers Home Administration Young Farmers Program, and by golly, they lent it to me. So I found this feedlot operation in Verbena, Alabama, which is Chilton County, that the bank had taken over. That should have been my first sign. It was a really nice cattle and hog feedlot operation, all the latest everything that some farmers there, experienced farmers, that should have been my other first sign, had gone bankrupt. And this was due to a lot of things. This was I don't know if y'all studied about the oil embargoes of the 70s, and when oil prices went, gas prices went from $35 at the pump to $4 at the pump, and runaway inflation. We had all kind of economic issues back there. We had wage price controls that Nixon put in place to stop inflation, runaway inflation. Now we're hoping for a little inflation. So I get out and start this feedlot operation, and I battled it for about 3 years and get out alive. Finally paid off the debt and got through. It was horrible. Corn prices spiked, interest rates spiked, fuel prices spiked, so it was a great education. But I decided, okay, I need to support my family. So the first step, and I was mentioning this earlier, you always need to be very careful about how you present yourself and how you promote yourself in public. And because I was sitting in a high school football game, and the guy next to me, I started talking to him, and he was in land sales. He bought and sold large tracts of timberland. This was pre-1986, before they changed the tax law, where, just to give you an example of what the tax law was before the '86 tax law change, you could go out, there was no separation between passive and active income. So if you were a doctor and had a large income, you could go buy a piece of cattle ranch, and you could get investment tax credits on your cows, and you could depreciate your cows, and you could do all these kind of things to create all of these passive losses that could offset your income. And so you didn't have to pay income taxes. Well, now the way the tax code is, they're separate. There's passive income and passive active income, and you can't offset them to get rid of these tax shelters. But what we were doing at the time, we would go buy these large tracts of timberland, and then we would sell them off into smaller tracts, and then they create these tax shelters for high net worth individuals. And so, I went from barely getting by to making a pretty good income. But before, I was working 7 days a week, and now I was working 20 hours a week, because that's by appointment only, and so I decided, well, I'll go to graduate school. I've got all this extra time. So the 80s were real big. That's when the MBAs were a big thing. Everybody, that was just a hot thing coming out of the Ivy League schools, and it was, all the major corporations were looking for MBAs. So I decided, well, I'll do that at night to have something to do, occupy some time, keep me out of trouble. So while I was doing that, I was continuing to do the land sales and the syndications of land, but I knew the tax law was changing. Reagan was in, it takes years for these tax laws to change, but it was pretty clear that the tax laws were changing. I knew this was going away. So again, going back to be careful how you present yourself at all times, I was playing on a church softball team, and it just so happened that the head of human resources at Protective Life was playing on that same softball team. And so Protective had gotten caught up in this MBA thing, and so they would have these MBA fairs every spring, early spring, and they'd have, MBAs come down from Wharton or Harvard or Stanford or Vanderbilt or Emory, and they'd do a couple of day fair and have 25, 30 MBAs come down, and they'd hire about 3 of them every year. Well, in 1984, I was finishing up my MBA, and for some reason, there had been a pretty bad period of economics between, 1978 and 84, but the economy was starting to come around. Interest rates were starting to fall. A lot of things were getting under control. So Wall Street was hiring that year. So Wall Street sucked up every MBA they could find from everywhere. Lehman Brothers, Salomon, all these that are no longer around. So, Kidder Peabody, all the ones that over the years that have blown up, they sucked up all the MBAs. So, the head of human resources said, Carl, will you do me a favor? We got this MBA fair. I wasn't really looking at a job at that time. Would you go through this MBA fair and help me out? And I said, Bill, I don't even have a suit. I mean, I wear a sports coat, no tie to, church. I don't even have a suit. So he kept after me, and finally I borrowed a suit. I didn't even have one. And I went into this 2-day fair. And a lot of the kids, they ended up having about 12 or 15 kids come down from all these great B schools. And they were really sharp, smart kids. A lot of them were a few years younger than I was. Just really bright, smartest kids in the room kind of kids and everything. And, so I went through it, and I went through it sort of a lackadaisical manner. And, you spend an hour with the CFO, you spend an hour with the CEO and the president and the chairman and all this kind of stuff. So I ended up spending 3 hours in the office of the chairman, a guy named Billy Rushton. And we spent most of the time talking about agriculture, ag stuff, land stuff, commodity stuff. What did you think about economic policy and all this kind of stuff? And so, it was just a back and forth. Milton Friedman, what do you think about his policies of economics? And it was just a very casual conversation of, here I'd been out working in the world and doing things, and a lot of it is more, if I thought about it more, it came back to my studies here. What we talked about here, in various things. Not my MBA school, which was all of the theoretical, highbrow stuff, but mostly what I learned in ag econ. And so I go away and don't expect to hear back from him. About a week later, Bill Hamer calls me up. The guy says, we want to offer you a job. And I said, yeah, right. You're kidding, right? This is a joke, right? So practically hung up on him. And then he calls back and says, no, I want to offer you a job. You were our #1 candidate. I said, Bill, quit jacking with me, man. This is not. I said, he said, no, this is our offer. And I said, well, I'm making a lot more than that right now. And he said, well, we took it a little bit. And finally, I said, well, I'm not really a corporate type. I grew up on a farm. I, had my own feedlot operation. Now I've been out independent contractor. One thing I didn't have through all that was 0 benefits. I mean, no insurance, no nothing. I said, this is a lot less, some less money, but maybe that's a good deal. I think I'll do that. And now here we are, 32 years later. I guess the moral of the story there is what you're learning here. You may be in ag econ, ag business, but it applies to so many more things, and it's a lot broader. It's a really good broad basis that you're getting here, which I was able to draw on a lot. So that's sort of the history of how I got to where I got to, and it turned out to be a great company that's been on a huge growth spurt. We buy a lot of companies. We in addition to selling retail, we do a lot of acquisitions. Two of our latest acquisitions, we bought the old mutual in New York company, Money, which you're probably not old enough, but 15 years ago, all you saw on TV was, Money was a huge company we bought a few years ago, and we just bought a big chunk of Axon and Genworth. So we do a lot of acquisitions, which is the wholesale accumulation of assets. So how does that all fit in to me, and what does ag fit into my job as a chief investment officer, and how does that fit? Well, I've got some slides, and I hope not to get too boring here, but one of the let's see, that's the clicker. There we go. This is the 30-year Treasury Bond. This is interest rates since April of 1980. This is the 30-year Treasury, which is the risk-free Treasury rate. 15, 16%. Now, if you're in business, if you're a farmer, and you have to borrow money at 16%, it's tough. You know, you can't buy land, you can't do anything, you know, you can't. But what has happened is over this period, the interest rates have dropped to 2.75%. Now, that has a tremendous effect on affordability of real assets and cost of capital. You know, if you can go out and borrow money at some margin over 2.75 versus a margin over 16, which you couldn't even borrow money back then. You could, I mean, you know, there wasn't a lot of credit. So this is the most phenomenal thing that's happened in my career, is a constant declining interest rate environment. The impact of that is just tremendous on all businesses and all being able to expand into capital. And so interest rates are a little low now, probably too low, because it hurts savers. You know, if you're getting close to retirement like I am, you want to earn a little more than 2.75% on your money. But this is incredible. And if you looked at the stock market at the same time, you would see the curve going the other way. I mean, it's more drastic going the other way up. And so, you know, that is the impact on the ability of the companies to earn money is directly correlated to the decline in interest rates. And this is a dropping in inflation. All right, the CRB is the Commodity Research Bureau Institute. Have y'all talked about that, what the CRB is? It's a basket of commodities. Well, it includes the prices of hogs, cattle, corn, soybeans, cotton, coffee, wheat, sugar, cocoa, orange juice, natural gas, crude oil, heating oil, gasoline, nickel, silver, and aluminum. This is a basket of commodities that the Federal Reserve and people looking at inflation look at heavily. And the interesting thing about this, and I'm leading up to a point, so I hope I don't lose you. For the 20 years, we had very little price increases. You know, from 81 through really April '06, before the crisis hit, you know, things stayed in a fairly tight range. So this was a period of no to low dropping inflation, which directly correlates to the interest rates dropping over the same period of time. But this is one of the main things the Federal Reserve looks at when they're doing their pricing of policy and creating Fed funds and looking at what's happening with inputs into final goods and services. So the three largest expenditures of a household are, you know, the cost of your housing, you know, energy, your fuel costs, whether it's related to heating your house and your automobile and food. So there's a big component of that right there. Let's see what's wrong here. Oh, sorry. There we go. Well, I went too far. All right. Now, a sub-index of that is cotton. Coffee, corn, sugar, wheat, soybeans is the sub-index of the CRB. Now, this is from 2011, 2016. Now, look how much agricultural prices have dropped during this period. You know, there's almost been a 50% drop in the prices of those items over the last 5 or 6 years. Now, y'all probably know why. Well, you know, agriculture is one of the few things where it's really driven by supply and demand. You know, you've had really good corn crops, you've had really good crops, so you've had a better supply. You've had less demand from some of the emerging markets, as there's been a slowdown in the emerging market economies. But you know, that's a pretty dramatic decline versus what we were showing a little while ago over that same period. Now, what is happening there is the emerging market growth. This is, you know, everybody heard about China, how much China was growing, and Vietnam, a lot of the emerging market economies, South America, Brazil. So that's demand for fuel, heating, aluminum, all other things that that was so much more overpowering. Well, just blew that one. Let's see. The price is dropping in agricultural commodities at this time. So why is agriculture important to me in my job as Chief Investment Officer? Well, agriculture and agriculture-related industries contributed $835 billion to the U.S. economy, 4.8% of the GDP. Food's 12.6% of household expenditures. And this is what I find: agriculture and agriculture-related industries like food processing is 9.3% of the total employment in the country. And the United States food and beverage manufacturing employment is about 1.5 million workers, which is about 14% of all manufacturing jobs. So it's a huge component. The services industries are by far the largest components now. But once you get past that, I mean, agriculture is one of the top individual contributing units to the gross domestic product and what goes into the economy. You can't live without food. You can't live without, so that's why it's important to me. And that's why you go back and look at the CRB indexes and the food indexes, why the Fed and the government and Federal Reserve is very interested in what's going on in those areas, because it does highly impact inflation. So in my portfolio, I have, what are my direct investments? I have direct investments in companies like John Deere, ConAgra, Monsanto, Tyson, Archer Daniels Mills, Caterpillar. I probably have about $600 million of investments in those companies. But what is it? It affects so much more. The steel industry, when you have manufacturing of equipment, huge impact on shipping. Shipping of cargo containers to companies, rail industry, trucking, fertilizer, chemicals, ethanol. It affects labor markets, and more than anything, it affects rates and inflation and the inputs that goes into the overall economy. So it has a huge impact on what I do in my portfolios. Most people wouldn't see that. Most people wouldn't think about that. But it is I have probably 500 names in my portfolio. But there's probably very few names that have as outreaching as arms into other things that agriculture do. So it is very important what I do, and it's what I learned here is very applicable to what I do as in the investment business. So I know I've covered a lot quick. So that's all of my prepared remarks, or not so prepared, you might think. So any questions? I would love to answer. If anybody has any questions. I know this is probably a different kind of presentation than you've been used to. That's more tied to agricultural production. Yes.
So the CRB index, okay, so orange juice. But I think there was a movie, it was about two investment guys, and they were selling like commodities, and it was orange juice. It was an old movie. But it was really funny, and I never understood why orange juice was on that list. Like, how did they say, okay, we're gonna choose orange juice, not apple juice, or how did they come up with that?
Well, the Research Bureau, and things change over time. If you look at, the largest exported agriculture out of Florida is oranges, and then you've got the whole citrus industry in California. So it's a big component, and a lot of it is export. It's a big export item. So that's how orange juice gets into that. So did it again. All right. So maybe this will prompt some more questions. You know, there's two truths about investments in markets. You know, I hate Christmas, not because of Christmas, because of all the Christmas parties, Christmas socials I go to, and everywhere I go, everybody says, what do I need to invest in? Tell me what I need to invest in. Well, you know, what? Give me a tip. Give me a tip. You know, all this kind of stuff. The only two things I can guarantee you about investments: markets always go too far in extreme versus the fundamentals. That's due to speculation, leverage, emotion, exuberance, or fear. So, you know, 3 years ago, whenever it was, when oil went to $160 a barrel, and today it went down, it went as low as $36 a barrel. The fundamentals have not changed that tremendously. Yeah, there has been increased supply, but a lot of it is due to speculation and, you know, leverage. So markets, whether it's corn or soybeans or cattle, it always tends to move farther than it should to the ups and downs. The other truth is diversification works. You know, it may lessen your upside, but it definitely protects the downside. You know, other than that, you know, there are trends, there are, you know, things that are good at the moment, but, you know, it's sort of a constantly changing environment. But, you know, there's an old saying, and when you're buying stocks, don't try to catch a falling knife, because, you know, it can go a lot further. When you think it's hit bottom the first time, about the next 5 times it hits bottom, it's about the right time to buy it. But, you know, but anyhow, that's how agriculture's played into my career, and it's been a very important aspect of it. I mean, in ag, you know, it's one of the few places that really supply and demand matters, and it's a commodity, and you're at the mercy of the markets. You know, the commodities markets, they show no favoritism. You know, so it can be a tough place to be and a great place to be. Any other questions?
What kind of advice would you give students in terms of investing or preparing for retirement in their first job?
Well, you know, the compounding, even at these low interest rates, compounding is incredible. You know, always take advantage of matching. If you have an employer, typically there's not anything, most of the retirement plans now are 401k plans where, you know, you put in a little money and the company matches, and you have a smorgasbord of investments that you can pick from. But I would always take advantage of the matching. It's free money. I mean, it's part of your benefit. So, you know, if you average in over 32 years, which I've been doing, you have high markets, you have low markets, but if you keep putting money in every paycheck, it accumulates. And it's a very good way of doing it. And just pick a diversified portfolio. Don't put it all in emerging markets, or don't put it all in the bond fund or money markets. Just pick a diversified portfolio, and just what's called dollar cost averaging, which I'm sure you know, and you just dollar cost average in over a long period of time. And, you know, with compounding, it doubles, it triples, it quadruples, it grows. And so, you know, that would be my best advice, is just take advantage of and start early.
So could you address this idea of continuing education? Students are here graduating in the next year or 2 or 4 or 5, whenever they graduate. But this is not the end of their education.
No.
Can you address ways that students can think about continuing to learn as they are in their career, even if it's not formally in a program?
Yeah, absolutely. You know, if you go into the agribusiness field, whether it's in banking or whatever it is, typically there are certifications. Like if you're going to, ones that people know most likely is a CPA for lawyers. In the investing world, it's a chartered financial analyst, a CFA. But most, whether it's an internal auditing or banking or whatever, there's typically something in that field that is some kind of certification and specialization that you can do. And it's very important. You know, we were talking earlier about the difference in classes now between what I had and what are available now. And what you guys are doing is so far advanced than what my basic classes were, and I can't even think of some of the names, but using all the technology and all the stuff that are available now in agriculture. So it's very important to stay abreast of industry trends and what's happening within your industry. And there's, I was talking to this young man earlier, he's, getting his statistics as well as his, degree here in agriculture, his PhD. So, there's very good to get a broad base and stay sharp, stay in tune, because it changes. One of the things I do every morning is I get up early, and before I even go to work, I read the Wall Street Journal and read every article there is on Bloomberg, because you got to stay abreast of what's happening in your industry, and it helps keep your mind sharp. There's a lot of truth to exercising your brain as well as exercising your body, and you can get into a job and you do the same thing over and over every day. Well, that's not good for you, and that's not good for your career. So even if you're doing the same thing every day, you need to still be expanding your mind and what you're studying and what you're learning. Whether it's the other thing now, there's so much online that you can do that you can stay on top of things.
What type of students are your company looking for? Some that maybe are straight out of school, and what characteristics can you say that are real important to your company?
Well, the thing that is more sort of my pet peeve is we have a lot of people come through, young, bright kids, and they never ask for the job. They never say, I really want to come work for you. They come to me and they say, well, you're developing real estate, you're building these office buildings, you're, buying stocks and bonds. I want to do that. But they never say, I want to come in and learn, and I want to have the job. So my best advice was, if you do your research, if you're going into Protect Your Life or Ag Credit or whatever you're doing, Monsanto for sales or whatever, know something about the company. And even if you're not 100% sure you want the job, you say you want the job, because if you don't say you want the job, you're probably not going to get the job. There's a lot of people out there looking for jobs, and so one of the things that you can do is show enthusiasm and show interest. Most of the time they already know you're smart. You can look at your GPA, look at your test scores, look at your resume, and then they know whether you're smart or not. It's probably already given that you're pretty smart because you got the interview. So what's going to set you aside when you get in and get the interview is, showing some enthusiasm, showing that you know something about the company and that you want the job. I think that will set you apart. But the kind of people we're looking for, we have everything from, marketing to accounting to actuaries to people who do data mining to, statistics and, a whole range. Our insurance is sold through independent agents, so we're not hiring agents that sell insurance. We're basically hiring people to manage the liabilities or the risk and or the assets. So there's a lot of jobs from cash management to customer service, for underwriting. There's a whole wide breadth of things, and most all of them are on the job kind of. You get the job and you go through some kind of training program. You can't walk in the door and be an underwriter. You have to learn what that is over time. And there are certifications, there are programs, there's educational things that you can follow. But to Dr. Wilson's point, you just keep learning. You stay on. There's always more to learn. Yes, sir.
due to the emotion and fear that you talked about earlier?
Oh, absolutely. 2010 was just, it was brutal. The Great Recession. We're typically very, very high quality assets, but it was so strange that you had companies like Lehman Brothers and other investment banks and banks that the rating agencies were saying that were A-rated, and then 30 days later they were in receivership. I mean, it was just so. The collapse of the structured market, which is the securitization of home loans, was really what set all that off. And yeah, I had worst investment I ever made. I lost $250 million on what was called Alt-A mortgages, which were, quote, AA rated, and which were literally fine one day, and 30 days later they were worth nothing because of the implosion of the market. And a lot of it was fear. Once people started selling, there were no buyers. And so when everybody runs through the door at the same time, there's no buyers, whether it's fundamentally, I mean, they were probably good at 50 cents on the dollar, but so many people running to the door at the same time trying to sell those securities, and the banks were going under, banks were getting taken over, the government was stepping in, there were no buyers, and so that was a fear trade. People, because of fear. We had a lot of recovery on a lot of those because we ended up writing them down and not selling them, and they recovered a lot. But we had at one point it was at a $250 million loss position.
Have you seen the fear of GMO foods affect the market?
Monsanto gets hit every now and then. There'll be something. There may be a court ruling in Europe, and even China here recently said they were going to be looking at that. So every time there's some headlines, then like Monsanto will get a hit on that.
Did you happen to see The Big Short?
Oh, yeah.
Carell, and
Yeah.
Did that seem pretty true? Till
Yeah,
the
it was
end?
close. It was a good.
Intense.
And I recommend the movie. It was a really pretty good.
Pretty accurate?
Pretty accurate about, there was some, Hollywood put a little entertainment factor in there, and there was probably some subliminal political statements in there, but overall it was good.
I've often wondered what someone actually in the industry,
Yeah.
what their perception of
Yeah.
how it was portrayed.
Yeah, the rating agencies, there was I think there was an inherent conflict in there. The rating agencies were getting paid to do the ratings, and the investment banking houses were shopping the ratings. They would go to the different rating agencies where they'd get the best ratings, and so there was
I
some.
was happy there at first.
There was some conflicts, real conflicts there on that.
So you mentioned that start early when you invest, right? So if, for instance, if you get a job, you could, in your company is public, you could invest in your own company, the one you work for. But if you're looking, to, and I'm 23 years old and I know very little about this, like what stocks are good, how do you sit down and see a list of companies like Southern Company or AT&T
Right.
or something and say, okay, this is, worth getting into? I know there's some sort of risk to it, but how can a 23-year-old sit down and go, okay, I'm gonna buy this, this, and this?
Well, what I would recommend, there's ETFs and there's mutual funds. If you have a company-sponsored 401k plan, the plan administrator is just going to give you 10 or 12 options that they have already screened and say that are going to be pretty good. you know, whether it's gonna be a large cap, small cap, emerging markets, you know, or a couple of bond funds and different things. So, you know, that sort of takes a lot of the guesswork out of it. If you're doing a company-sponsored plan. If you are an individual, you should only invest in something that you understand. So, you know, if you're, and again, but then you can't be concentrated, you have to be diversified. You know, if you, in ag engineering, and you just can't put everything in AGCO, you know, you gotta, you know, you got to be, or John Deere, or Caterpillar, I mean, you got to be diversified, but if you're gonna buy individual stocks, you need to buy something that you understand. I mean, I don't buy a lot of technology stocks because I don't understand them. I mean, I don't know what is emerging technology that's gonna sustain itself or not. I mean, you know, I love GoPro, and I'm like the spearfish, you go down to GoPro. But, you know, when GoPro went public, it was a huge price, it's way down now. Because, you know, is it a technology that can be copied? Yeah. And, you know, is it something that can easily be knocked off? Is it that there are many other uses? Well, the same thing to me is what's in a little cell phone or something. I don't understand technology, so I stay away from it. But, because I don't know what's good today is going to be good 5 minutes from now, much less 5 years from now. So just stay with stuff you know. And you know, how do you know something? Well, one, it can be related to what you do, or you can do a lot of research on it. There's so much research out there now. I mean, you can go on the internet now. If you're interested in Tyson Foods, and you can go get every one of their annual reports. You can get so much research from the USDA about poultry numbers. I mean, there's so much, but you're not going to do it. You're not going to get ahead without working, because there's at it. I mean, you got to really dig into it. It's nothing's easy out there. If it's easy, something's wrong.
What do you think will be a trend for the agricultural investment for the next 5 years, based on your experience?
The agricultural investment for the next 5 years?
Yes, the trend.
Well, you know, we were talking earlier about some of the, what you call that, where they're,
Precision ag?
Yeah, precision ag. You know, I don't know a lot about it, but it sounds like that's where things are going, in that precision ag. You know, we're typically investing in investment grade, pretty developed companies, not involved in the startups and the younger companies, but the precision ag thing sounds like that's where it's going to be. Yes, ma'am.
Thank you. Considering the agriculture have more uncertainty, do you think investment on agriculture there has more risks than other investment? For example, market stock, stock and some investment other area. Because agriculture comes easy to certificate, predict, because it's uncertainty.
Okay.
There is a difficult job than investment stocks.
So, let me make sure, is investing in agriculture more risky than other areas?
Yes, I think so, but I don't know that is right. Because I think agriculture is not easy to predict. You have more.
Well, I think there are factors that, you know, that drought, different things that can impact things pretty quickly. But not necessarily. I think that just like, you know, if you're trading commodities through like the Chicago Board of Trade, where you're doing commodity trading, that is not for the amateur. I mean, that is for the serious, you know, traders, and then that is high risk. But if you're hedging your positions or something like that, not necessarily so. But you know, if you're investing in one of these major companies like ConAgra or Tyson or John Deere or something, you've got very sophisticated, most stocks, 95% of them are owned by institutional investors. So you've got somebody there that is looking at these things day in and day out. And unless there's surprises, you're not going to get tremendous movements. I mean, there's always the fraud, there's always even in today's world, there's, you know, cases like Valiant, the drug maker that, you know, has distorted their financial statements, and you'd have some of that, but for a well-established, well-run company, you know, it's pretty much going to follow the fundamentals. Yes?
I have one question. A lot of our students have farm background, or they are from Alabama or from Georgia. And I teach the finance class, so I try to expose them to the influence of what's going on in the markets overseas. Can you elaborate on how important this is in your job and how it might affect, in general, agriculture, but also personal investments throughout our life?
Yes, if you, how the overseas markets,
Yeah.
are you
The
mean?
link of financial markets.
The financial markets, oh yeah, absolutely. Well, you know, with the financial markets, it's always the incremental buyer or seller that makes a difference. You know, there's an equilibrium. If, you know, if there's an equal amount of buyers and sellers, then the stock would stay at the same price, or the bonds or whatever would stay at the same price. So it's the incremental buyer or seller that typically moves the markets. And so what has happened, you know, over the last 10 years, going back to that first chart on the CRB that went up at the end, what we call the emerging markets, which is, you know, China, Brazil, Russia, you know, some of the Latin American markets have been have had growth in their economies. They're, you know, the huge amount of emerging middle class in China, and where the standard of living is increasing. And so where those standards of living is increasing and the demand, that is what's been driving markets. And the U.S. markets are still the safe haven. I mean, of both the Treasury, the bonds, and the stock market is, we're the safe haven of, we're the safest, more stable markets, most developed in the world. So if you look at growing GDPs, if you look at how our economy grows, you know, it can grow just out of sheer numbers, population growth. So like in Europe, you don't have any population growth, or Japan, you don't have any population growth. So, you know, having a growing economy is tough. The other way you grow the economy is have an increased standard of living. You don't have the same amount of people, but if they have a higher standard of living, more money to spend, that drives the economy higher. Productivity can work both ways, but generally you want to increase productivity. You have increased productivity, increased population, increased standard of living, you have a strong economy. And that's what you've had from some of the emerging markets, and then that flows over into, you know, to the United States. Does that answer your question?
Yes. We are very safe, but also we are the ones who exported the biggest financial crisis in
That is true.
10 years. So.
Absolutely.
So we are connected. That's
Absolutely. Yes.
So how large is protected now? How large was it when you started in '84?
We've you know, it's really interesting. In Birmingham, when I started in '84, we were about $1 billion in assets, and we had about 2,000 employees. Now we're approaching $80 billion in assets, and we still have about 2,000 employees. In Birmingham, we have another 1,000 elsewhere, but that is the power of technology. I mean, when I started, you know, there was one desktop computer in the whole department, and so, you know, that's what you know, growing productivity. I mean, we've got 8 million customers, $1 trillion worth of insurance in face, and, you know, and so it's, the technology has just been a phenomenal thing. You know, there were the old punch cards, you know, now I can't keep up with it. Well, any other questions? I think I've pretty much used my time. Well, thank you. It's really good to be back at Auburn. I mean, Auburn's such a great place. I know y'all appreciate it, but you really will later.